disallowed deductions. So there's a concept that we've discussed in the past called reverse discrimination. And reverse discrimination is the idea that the more money you earn, the less you get to participate in certain benefits, be they employee benefits or tax benefits, and even higher at the income levels, you may not be able to participate in them at all. I'll give you some examples. Going back to the screen, a very popular investment that people use to set themselves up to have income tax-free dollars in retirement is the Roth IRA. Roth IRAs, you put in money that has already been taxed, and in exchange, when you pull it out in retirement, you pay no taxes. However, based on your income levels, you may not be able to participate in a Roth IRA. Looking on screen, if you have an adjusted gross income as a single person that's over $165,000, you can't contribute directly to a Roth IRA. If you're married filing jointly, $246,000. And I'm going to put a pin in this. If you're married filing separately, $10,000 is the adjusted gross income limit beyond which you can't contribute directly to a Roth IRA. We'll explain why in a second. The next is something that requires a little more of an explanation. IRA deduction phase out for active participants. So let's walk through this. A deduction means, remember, that you are using it to reduce the income on which you pay taxes. And when you put money into pre-tax IRAs, you get a dollar for dollar tax deduction. Now, the pre-tax deduction is the major benefit of using the IRA, because if you don't get the deduction, why would you set yourself up to pay taxes twice? I have to pay taxes on the money when I put it in, and I have to pay taxes when I take it out in retirement. You wouldn't do it. However, if you're an active participant, you are restricted as to how much you can earn and still get that deduction. What is an active participant? An active participant is someone who has a retirement plan available to them at their employer, whether or not they choose to use the account. If you're an active participant and you're single, you cannot get a deduction for pre-tax IRA contributions once your adjusted gross income goes above $89,000. Married filing jointly, $146,000. Again, married filing separately, $10,000. We'll come back to that in a second. And a spousal IRA. What this means, a spousal IRA is for a person who does not earn enough income to justify their own IRA contributions, because IRA contributions have to be based on income. You can't just make no money and contribute to an IRA. However, you can open a spousal IRA and use your spouse's income to justify your IRA contributions. But what they are saying is, if you're, say, for example, a stay-at-home spouse, and we're deciding to open up a spousal IRA, if your spouse is an active participant at their job and your family's adjusted gross income is over $246,000, you still can't get that tax deduction for the pre-tax IRA. And this is an example of reverse discrimination, either reducing the amount that they can deduct or disallowing the deduction because of how much they earn. Now, to my comment about married filing separately. If you listen to our Escape Student Loan Debt podcast, which is a separate business entity from New Money, New Problems, you're aware that there are plenty of people out there who are married and have federal student loans, but their spouse does not have federal student loans, and they don't want their spouse's income included in the calculation for their student loan payment under income-driven repayment plans. The way that you would avoid that spouse's income being included is to file your taxes married filing separately. There are other reasons why people will choose to do this. They may have a year where one person has a lot of medical expenses. There's a whole host of reasons. But when you file married filing separately, it is a very big decision. The first is because the federal income tax tables are less forgiving for people who married filing separately as compared to people who file married filing jointly. But you also, in many cases, like what we're looking at for the Roth IRA in terms of how much you can earn before you contribute, or the IRA deduction for active participants, will have a severely reduced eligibility for certain tax deductions, or you will not be able to use those deductions or tax credits at all. Example of completely disallowed deductions are the Earned Income Tax Credit, the American Opportunity Tax Credit, the student loan interest deduction if you earn below a certain amount of income. In terms of ones that are reduced, the child tax credit is reduced in terms of how much you can participate if you are filing your taxes married filing separately, as is the retirement savings credit. There are a whole host of things that you either can't do or can do less of when it comes to filing your taxes married filing separately, because this is not something that the IRS wants to incentivize. So a combination of the high income and also making the decision to file your taxes married filing separately, even if you're getting a huge benefit from your student loan payments, you would want to make sure that that benefit in terms of saved student loan payments exceeds what it's costing you in extra taxes by making that decision, because it's not one that should be taken lightly.